Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Warner Brothers Discovery stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 19 billion market cap. They're trading at $8 a share and they have 2.4 billion shares outstanding. Warner Brothers Discovery operates through three segments: studios, network, and DTC, direct to customer. The studios segment produces and releases feature films for theaters. It also produces and licenses television programs and offers streaming services. Its brands include HBO, Max, Discovery Channel, CNN, Food Network, TNT, TLC, Warner Brothers Games, Batman, Superman, Wonder Woman, Harry Potter, Looney Tunes, Hanna-Barbera, Game of Thrones, and The Lord of the Rings. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Look how much our free cash flow has grown. It went from 2.4 billion to 6.7 billion. And I'm sure you know why it grew so much. I'll give you a hint: AT&T. Net income is the profit or loss on the income statement. It's revenue minus expenses. Look at this, 900 million to negative 11.8 billion. Lots of write-downs, lots of goodwill impairments. Revenue is sales for the company, and that went from 12 billion to 40 billion. It was higher in 2024, 41.3 billion, down 3%. We estimated 4 years of future free cash flows. We also estimated the terminal value of total cash flows past year 4, that's 46 billion. We discounted those numbers back to today using weighted average cost of capital. We got a value of the company of $46 billion. We divide that by 2.4 billion shares. And we get a calculated stock price of $18. They're trading at $8, so they're trading at a 56% discount. It's a really strong buy according to the model. Do you think it's a buy or sell? Let me know in the comments. Simply Wall Street is really close to me. They're at 20 bucks a share. They say the stock is 60% undervalued. 27 analysts priced this stock at $10.58. They also say it's undervalued. There are 42 companies in the same industry as WBD, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 1.2 billion in capex, second highest on this list. Debt to equity ratio 1.2. That means for each dollar of equity, they have $1.20 of debt. They don't pay a dividend. Free cash flow 6.7 billion, second highest on this list. They rank 5th in market cap, should probably be 4th. Price to book is really attractive at 0.6. That means investors are paying $1 for 60 cents of book value. We can't look at their PE, negative earnings. They're trading at 3 times free cash flow, which is by far the best on this list. This should be highlighted, forgot to highlight that. Price to sales 0.5, which means their revenue is double their market cap. And look how much they're growing. Their 5-year annual revenue growth rate is 29%. Here's their latest income statement, second quarter of 23, second quarter of 24. Revenue is down. It was 10.4 billion, now it's 9.7 billion. Distribution revenue 4.9 billion, that's down. Advertising revenue 2.4 billion, that's down. Content 2.1 billion, that's down. Other is up, that's 300 million. Cost of revenue 6.2 billion, that is lower, so they're lowering expenses, that's good. SG&A 2.5 billion, lots of impairments, lots of write-downs, so their total expenses is 19.9 billion. Operating loss of 10 billion. It's mainly because of this large impairment. So their net loss is 10 billion, last year was a net loss of 1.2 billion. And shares outstanding are pretty much flat from last year, 2.4 billion. So to summarize, I have them trading at a 56% discount. I give them a ranking of 5 out of 10. It does seem really undervalued. It's almost too good to be true. Why is it so undervalued? Why aren't more people buying the stock? Would I buy a 3 out of 10? Because a trend is your friend. In this case, the trend is going down. I think it's going to continue going down. So I probably wouldn't buy it yet. Ratio is 8 out of 10 because of that price to free cash flow. It's below 3, which is unreal. Financials 10 out of 10, even though it's through acquisition. But look at that growth. Free cash flow up 178% since 2022. Revenue up 228% in the same time period. So that's the end of the video. Let me know what you think. Give it a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.